Hello, I am back again with part D of this video 3. Now we will try to see what happened in 2001 to 2005. More than 13 nationalized banks, they came out with their own IPOs. That was the new concept. The IPOs were brought in and those IPOs were worth 8,419 crores and OBC was having the highest IPO of 1,450. At the same time, ICICI also came with its own IPO and it was of 3,150. And the banks like Allahabad Bank, Andhra Bank, Bank of Maharashtra, OBC, Canara Bank, IOB, Punjab National, Vijaya Bank, Syndicate Bank, many banks came with IPO and many of those banks subsequently came out with FPOs and many other banks, those who have not yet come with the FPO, in today's scenario they are trying to create their own buffers and they are planning for more FPOs to come into the market. Now, during this period itself, the expression of interest were invited in July 2002 and the new concept of CBS came into the banking industry. And its implementation started right from 2002, but actual conversion of the branches and all the networks in CBS, it started from August 2000, actually in 2003. And RBI, through a specific circular issued by RBI in 2004, they said that almost all banks should be CBS compliant, latest by the year 2012. And accordingly, all the banks, one by one, and during those periods, I remember the bank employees, the IT people, they toiled like anything, and branches after branch, offices after offices, they converted into CBS, initially standalone, then satellite based, then telephone lines based, and today the entire CBS system is well in place and which is quite competent to deal with the international competition as far as the technology is concerned. To that extent, I would give my all salutes to the employees of the nationalized banks as also to the employees of private banks, those who developed the entire CBS system. When on one hand talk for CBS was going on, so naturally what was prudently thought by then government and the management that as and when CBS would come in, the staff would become excess, no recruitment will not be needed, and that is how the idea of VRS was floated in banking industry. And the purpose of VRS being pushed in the banking industry is that they wanted to save more than 2,100 crores of staff cost every year. So from 2001 to 2020 today, the Indian banking system has already saved 2,100 crore per year. They have saved. And they wanted to reduce the staff at least 15%. We will look to the statistics about that. That time when the VRS came, in Indian banks, the number of employees were 8,63,188, of which 1,26,714 they applied for the VRS, and that was 14%, 14.7%, 15% target was there of the rulers and bankers. Out of those, more than 80% VRS applications were approved, and as of 31st December, the entire 2001, the entire scheme was over, and most of the employees whose VRS were accepted were relieved. And the number of employees, those who were relieved as a result of VRS, were 1,01,300, which comes to around 12%. So though not 15%, the 12% employees were reduced, and the era started. Then more and more mechanization came into banking, and recruitment was stopped, and the recruitment of specialized officers in banking, right from IT, agriculture, marketing, then your law, and all these recruitments, they started coming into that. In 2002, Competition Act came into force. So how the bank should deal and how the competition should be regularized. And during that period, the another committee was appointed in 2003 under the chairmanship of Tarapur to have uniform procedures and performance as far as audit is concerned, as far as the competitions are concerned. And that gave the birth to Banking Codes and Standard Boards of India. It was registered as a society under the Societies Act in 1860, but it came into power from 2006. Now in March 2004, we will go a little back. In March 2004, as I told you, private sector banks and foreign banks, the combined share was 20% of the total assets in the entire banking industry. Now in 1992, we'll go a little back. The Basel Accord, the capital standards were adopted right from April 1992. Capital adequacy was required to be maintained, and foreign banks having presence in India were forced to maintain it by 1994. But Indian banks were given little leeway, and they were allowed a time up to 1996, during which period the Basel Capital 8% norms was required to be maintained. Now again coming forward, in 2003 and 2004, India ranked second worldwide as far as agriculture growth is concerned, as far as fisheries, as far as milk production, as far as forestry, and the growth in the employment rate was more than 60%, thanks to the role played by mainly nationalized banks and the entire banking sector. But on the other side, during 2004 itself, the Global Trust Bank, which was formed, it was required to be merged in Oriental Bank of Commerce, as I told you earlier. Now, during the period 1998 to 2004, new era of CVC came into picture. We know today the finance minister is required to tell the bankers, don't worry about CVC. You should lend so long as you are following the prudential norms. Don't worry about CVC. The CVC, these three words, those who are scaring the bankers, they came into existence during the period of 1994 to 1998 to 2004. And the ordinance was issued by the President of India. As a result of that ordinance, the CVC got the regular virtual status on 25th August 1998. Now in Indian context, as we look into, the government passed resolution in August 2004 and it authorized the CVC as a designated authority to receive written complaints and disclosures of any allegation of corruptions and misuse of powers, misuse of office to be received from the common man of India. Followed by this, that is how the CVC became all pervasive. Anybody can get up and lodge a complaint with CVC, and the CVC will scrutinize and having huge powers to investigate the books of the banks also. So it got a status as a result of the ordinance by President of India. In 2005, the another milestone was Right to Information Act. The state government, the central government, and the act were established, and the vigilant commissions were also considered as a tool to reduce the corruption, as well as the Right to Information Act was considered to be a tool to be given within the common man of the Indian population with a view to control the corruption. Now a little back we will have to go. Since the economic liberalization, which facilitated the top in India, and the vast era of entrepreneurs, they came into picture, software boom came, that gave birth to the international companies, those who had Indian origin. To quote the example, Infosys, Wipro, HCL, they came on the Indian scene. In infrastructure, Adani and L&T, they came into the scene. As far as the telecommunication is concerned, Bharati and Airtel, they came. As on today, what is happening to telecommunication, we'll come to that in my last videos. Then steel giants, they came into picture, Jindal and Bhushan. Now what has happened to those steel giants during the recent era of last 5 years, when the economy started weakening? It's not part of this, but we will have to accept that during this period only these giants, they came up thanks to deregulation, thanks to the opening of the economy. And during same period, as far as the banking scene is concerned, in private sector, ICICI Bank, HDFC Bank, Axis Bank, Kotak Bank, Yes Bank, they came. Yes Bank, we know what has recently happened, but this is not the topic of today's discussions as far as the private banks and private companies coming to the Indian scene. Now, new concept which was introduced in the Indian banking system in 2005 was banking correspondents and banking facilitators. What was that? The RBI thought and government thought that banking correspondents and banking facilitators, those who will penetrate in the deep rural areas where there are no roads, where there may not be electricity, and banking services can be offered to the rural poor where brick and mortar branches cannot be opened. And initially, government and RBI also thought that banking facilitators and banking correspondents should be used as a substitute for a brick and mortar banks of the nationalized banks. On one side, RRBs were there. Subsequently, India Post also came, which had a very strong network in rural areas. But that we will discuss in the last video. Now, when this concept was launched, out of 50 public sector and private sector bank, 27 banks picked up the appointments of BCs and BFs immediately. And on the other side, the RBI, which was saying that after every 2000 population villages, there should be a brick and mortar bank, RBI went back and they said instead of 2000, now let it be 5000. Per 5000 population, let there be a brick and mortar branch. But even today, that percentage has not come to 5000. It still remains to be 11,000 population per branch, rural branch in India. About that we will come in the next video. So what were the powers given to the banking correspondents and banking facilitators to entertain the transaction up to 2000 and small ticket loans in deserving cases up to 10,000. As on the last report available, we will go beyond 2005. As on the last report available, there are 2,48,000 banking correspondents and more than 3,33,000 banking facilitators. To that extent, they have grown. And the next giant step, which was taken by the government of India, at that time the ruling party, Manmohan Singh was the president, the Manrega came into picture. Now, as far as the Manrega is concerned, there were different views of different political parties, but today we all know Manrega is proving to be a pillar as far as the providing the jobs to the rural poor. And this was introduced in 2006 in the name of Mahatma Gandhi, named as Mahatma Gandhi National Rural Employment Guarantee Scheme, that is Manrega scheme. About that, I am not dwelling at this stage in detail because time at my disposal is very short. About that, I will be discussing in my last video. In 2006, the Tata Group opened up its wings and costing $12.98 billion, Tata acquired a UK-based company, Chorus. So that was the era when the Indian companies with Indian origins, they started going beyond Indian horizon and they started capturing and acquiring big giants, those who are operating in international markets. That is how the role has been played by the nationalized banks. They sustained the competition, they came with the CBS, they played their role, they looked after the mass banking, they did class banking, they upgraded their technology, and that is how, as I told you, only 20% share was in the hands of the private banks, and more than 80% share of the banking business was there in the nationalized banks. And that is how the situation came that the Infosys became giant, L&T became giant, Adani became giant, Reliance became giant. As I told you, Tata's became giant, and those they acquired the company Chorus. With this, I take a short break. I will conclude this part D of this video 3 of this. And in my next video, I will take not more than 5 to 7 minutes, but I would like to explain the data as far as the progress made by the nationalized banks in developing the Indian economy as one of the best and leading economies in the world. With this, I stop here to conclude my part D of this video and see you in part E of my next video. Till then, goodbye. Thank you.